Joining us now, Jeremy Nelson, partner at Element Wealth. We are, of course, in the Element Wealth studios. Jeremy, thanks for coming on.
Always a pleasure.
I'm watching the Dow right now, up 580. So before you came on, I asked you what's driving it today. Normally there's some news. I don't know exactly. You said you think maybe it's just oversold and money's on the sidelines getting back in.
Yeah, look, Rhino talks about the kangaroo, right, on a stick, up and down, up and down. And, what we've seen over the past few weeks is you had a market that was oversold. There's some buyers, who are interested in the market at this level. Not a ton of volume, right? They come in, they buy, market goes up on light volume. Then a few people want to sell, it goes back down. We're kind of just in that seesaw right now where you've got some buyers, some sellers. You're getting, a little bit of up and down here. But generally, we've been kind of hanging around the bottom that we set a few weeks ago. Yeah,
and so the past couple of weeks we've had earnings reports, and they haven't been quite as disappointing as we thought. There was some disappointment this morning, I believe, from Snap, where they reported ad revenues down, and it fell pre-market. It was down 25%.
Yeah. Advertising, so if you think about businesses, right, there's top line, right? You got money coming in, and then you've got the bottom line, right? The money coming out or profits, and you can control profits if revenue is not coming in at quite the rate that you want. You can control costs. Well, advertising is one of those things that you can cut back on.
Usually gets cut.
A company like Snap is going to be a little bit more affected, right?
Yeah.
I was in Atlanta last week. I was meeting with a client and a friend of mine that works for Google X, and she was just talking about how there's company-wide cuts on traveling. She's in Atlanta. She's not going to have to fly back to California for at least the rest of the year is what they're telling her.
Interesting. So it's a little bit of a pivot, shall we say, in that I think we went through a period, especially with the infusion of all the money into the economy, where a lot of companies maybe got a little complacent. And we're spending money probably didn't need to or maybe wouldn't if revenues were down and there was some stress placed on the company. And you were just saying before we came on the air, maybe sometimes this can be a silver lining in that it forces companies to get a little bit more efficient.
Yeah, I think, I don't want to be the one that says recessions are a good thing. Recessions are not a good thing.
Sure.
But in business, when you go through a downturn, it creates opportunity to eliminate fat and become a better business longer term.
Yeah.
So to that degree, it is necessary every once in a while as we go through down cycles where you're able to, kind of go in, cut some of the fat out of the business, and ultimately you come out a leaner and better business.
No doubt about it. And so, but the concern, of course, that we would have from an investment perspective and just an overall economic perspective is how that might affect capital investment. I've always been a believer sitting in that chair and having to make those decisions is faith, confidence, and certainty that drives investment, expansion, hiring.
Yep.
And when you don't really have that, at least for some period of time, you tend to just hunker down and say, we're just going to kind of stay put here and maybe even reverse some plans as a result.
I think that's what you're seeing in corporate America today is, there's not a lot of businesses that are losing money now.
Right.
But there's question marks about the uncertainty going forward. So I was talking with a client recently who does air compressors, big industrial ones. And they were saying, look, we're not inventorying as much as we were because we're concerned we don't want to get stuck with it. And they had to inventory a lot because of the supply chain issues. So they were taking whatever they could get. They'd have inventory. They're not doing that. The longer that businesses stay in that mode of paralysis, though, right, where they don't have confidence to commit capital, then the risk of a bigger recession looms.
Yeah.
Right. So that and the number one thing that everyone is hinging on today is the rate of inflation. Everyone's kind of waiting to see, are these numbers going to come down?
Yeah. Well, and speaking of which, we've been watching Federal Reserve policy with a great deal of interest, and of course they keep raising rates. And we had some sell-off last week when we got CPI, and it actually trickled up a little bit, and so that is thought by investors to be a strong justification on the part of the Fed to continue with the aggressive trend. I think now the prognosticators are saying 100% chance of 0.75 of a point in November, but that's not going to be it.
No, if you look, we've seen the 2-year now tick up towards that 4.5% range, right?
6 months, 4.5.
Yeah, we saw the 10-year today hit a 14-year high. We're pushing 4.25% there. So rates are ticking up, factoring this in. Now, I will say I was on a call with one of the major asset managers recently, and one of the head of credit for this firm at one of their due diligence trips had said that he would bet his bonus check that in a year from now the 10-year will be lower.
Really?
Mm-hmm.
Well, that would be good news for the mortgage industry and the credit industry in general, from a consumption perspective, certainly. But
the thing that's got to happen there is the inflation has to come down. And some of it is because people are starting to bake a little bit more of a recession case in for next year. And
they think a pivot's in the works.
And I think, we talked about this a while ago, but, our forecast is that you do get recessionary pressures as you get towards the latter part of next year.
Yeah.
Right? That's where we see the rubber meeting the road.
My concern, and want to get your thoughts on this, is that we've seen rate increases, but we've seen no abatement of inflation thus far. And essentially the only tool, for the most part, the Fed has is to monkey with rates, essentially. And you got the president who says, this inflation thing, I'm out. The Fed, Jay Powell's going to handle that. Well, that's not working. And you've seen a couple of presidents this week say, so far we've raised rates. We don't see any adjustment to inflation. We got to have some fiscal policy changes.
Well, yeah. So on the inflation front, if you're looking forward, right, and you look at what's happening in the housing market, so you and I were both at an event where the analyst from the Atlanta Fed was there.
Yeah.
Great job. Did a great job speaking.
Sure did, yeah.
And remember, he talked about the layers of the onion with inflation, right? And I thought that was a good analogy.
I did too.
And he talked about, on the outside, you've got the transitory costs, right? You've got the commodity prices, those sorts of things. Then you get into the supply chain issues, and then you get into inflation expectations at the core and people making decisions, right? Boots on the ground.
Yeah.
And so if you kind of look forward, the transitory costs have gotten better. Supply chains still not great because China's zero COVID policy.
Yep.
So companies are having to adjust, reset up some of their supply chains in other parts of Asia because it's still cheaper to do that than it is to build
takes
in
time
America.
and money, though.
So it takes time and money to do that. And then from an inflation expectations, corporations aren't spending the money, right? So if you look forward, aside from the supply chain issues, there's a lot of reason to think that these numbers are going to be coming down, that we are peaking, and that was kind of the message that he had in that speech. So that inflation is peaking, will come down. But the caveat to that is we're not going to get back down to the 2% target even next year, I don't think. And
I don't either.
And we have, we've been a little surprised that CPI has stayed as high as it has.
Yeah.
We really thought fourth quarter was where we'd peak in the summer and we'd see it coming down in the back half of the year. Seems like it's probably peaking now and will start coming down in the later this year in first quarter.
My concern is that this government, this administration, is totally relying on monetary policy as the tool address this inflation issue, and I'm just not sure if that's going to do it. They're always focused on demand.
You got to stop. You've got to stop handing out money.
I know. I agree. We're going to take a break right here. We've got Jeremy Nelson, partner at Element Wealth. We're in the Element Wealth Studios. Guarantees Jeremy Nelson, the partner at Element Wealth, in the studio. So let's talk about real-world stuff, Jeremy. And I know we discuss this whenever you're on, and I think rightfully so. Folks are looking at their nest eggs. So a lot of folks that are approaching retirement, and they've been saving their entire lives, their entire careers, putting money away for that day. They're seeing the finish line, and they're saying, I'm worried. I don't think I've got enough to make it, and I'm going to have to keep working and postponing my planned retirement. Are you hearing? You seen a lot of that?
Yeah, so actually here's an interesting case. So we had a prospect that came in and met with us last year.
Okay.
Was looking at retiring at the end of this year. And so we built his financial plan. Now, this was based off of our expected returns going forward, which were low because fixed income yields were so low.
Yeah.
Well, he continued to handle it through his 401k, and he came back in a couple weeks ago, and he had 20% less money, which a lot of people are facing right now.
Yeah.
I updated the balances. I increased our expected return to reflect the higher interest rate environment that bonds will yield. His plan was actually better.
Okay.
So it might not be as bad as you think it is, because on a forward-looking basis, right, your returns are going to be higher because bonds, which will make up a larger portion of your portfolio when you're retired, are going to yield more.
Yeah.
But that being said, it is really, really important that you kind of go through that process and look and see, well, what are the expectations that are built into our plans? And we had been really cautious on what our expected returns were because we saw a stock market that was, overvalued to a certain degree. We saw interest rates that were really, really low, and you kind of knew that rates had to go up at some point. We did not expect rates to go up faster than any time in recorded history, but you knew that they were going to go up, so you kind of had to bake that in. So I think if people are looking at retirement, you just need to really sit down, figure out what are my income sources going to be, Social Security, pensions, other things. How much do I have? What are my expenses? And then what are my expected returns going forward? And if you map it out, you might actually see that you're still okay.
Yeah, so that's a good point because we have experienced for the last several years an environment where there was just minimum income opportunity from low-risk income-producing securities.
Yeah.
Certainly couldn't do anything with T-bills.
Yeah.
You had some corporate-grade bonds. You got dividends. But, those have ticked up. When you got 6 month now, you could roll money out of equities if you wanted to get on the sidelines for a while. In the 6 month, get 4.5%.
Yeah, so our place to hide out on fixed income had been shorter duration high yield, and we were at least getting 5% there. Well, you could pretty much get that in a 2-year Treasury now.
Yeah.
Right? So you don't even have to take as much risk in your portfolio to get the yield in there. I mean, high yield's now yielding close to 10%.
Yeah.
If you factor in, 2.5% for default, right? That's more than during the financial crisis. You're still at 7.5%.
That's a good point. Yeah, we hadn't seen that in a while. The ability to produce that kind of income.
So I think the offset to seeing the declines in our portfolio is that actually the opportunity set of what we can do going forward is significantly better. You're seeing a lot of stocks now that are yielding 4.5%, 5%. Companies that have histories of growing those dividends too. We've been running analysis for some of our income investors, and our income is now higher. Yes, market values are down, but the actual income that we're generating for them to live on is actually higher than it was.
And that's a great point because I think a lot of people maybe are looking at their nest eggs and not really going through that exercise, but are rather thinking about, I'm not going to put this money at risk. I'm just going to draw out of it to live. And maybe not considering making an investment with that, and they've got to be careful, is because that's their source of income. So you're not going to be as interested in risky positions. But and the problem was in the past, well, okay, you're not going to invest in some risk assets, but if you invest in low-risk assets, you can't make any income off of. But now you can, and that's the point.
Yeah, I mean, you can literally have a very conservative to moderate portfolio and have very high levels of yield. I mean, over 4 and 5% now.
Yeah.
So just the income on the portfolio to support your retirement is significant.
And not subject to the volatility of equity investing.
Now, as we're learning, right, bonds have a level of volatility as well.
They do. But short term is a little better from a risk perspective, and you get decent returns on that.
But I will say this. There will be a time where you're going to want to lock in some of this duration, have some longer-term bonds, and lock in those coupon rates.
And that's what your firm does, essentially, is help with that. Those machinations. It's complicated. And full disclosure, I think I've said it before, I'm a satisfied client of Element Wealth. Jeremy has managed my portfolio quite expertly. But you and I were just talking about it not long ago. Because of the increase in rates, which has propped up income-producing assets, our income is up as a result of that without increasing our principal. We're just producing more income on an annual basis.
Yeah, we've seen dividends go up. We're seeing bonds that are maturing, reinvesting at higher interest rates. We're producing more income than we started.
Yeah, and so that's kind of the silver lining of the interest rates is that while if you're borrowing money, it certainly costs more, but if you're investing money in fixed income securities, you can produce more income.
Absolutely. And I had someone ask me this question at a parents' event for my kids' school, and they said, kind of what's the key to, being successful in retirement investing? And I said, don't get attached to what you've got, right?
Yeah.
Because it's floating every day, and I don't mean to say that tongue in cheek, but you have to really understand what you own and why you own it and what it's producing, and have a long-term plan. Because if you make emotional decisions during times like right now, then you're going to hurt yourself. And when this market comes back, it's going to come back rapidly.
Yeah.
And when interest rates drop, right? If you were sitting in cash or all short-term assets, well, you're not going to get any appreciation on your bonds.
Yeah.
So you've got to be really intelligent, and that's why we always talk about the concept of building income growth and guarantees. And if you've got those three legs of the stool, then your plan can withhold whatever comes at it.
Yeah, it makes sense. We should also point out, for the benefit of our audience, federal Treasury bills, notes, bonds are not subject to state income tax.
Correct.
Municipal bonds, those would be debt instruments sold by municipalities, are not subject to federal or state, correct? But generally, the yields on those are a little lower.
They're lower. And actually, right now, I ran this analysis the other day. I was looking at corporate investment grade versus municipal. And even at the highest tax rates, corporates are actually attractive now relative to but you still got to pay the tax.
Yeah.
But the net yield you're going to get is actually higher than munis right now.
Well, that may drive up muni returns somewhat to be competitive, right?
Yeah.
So out in the marketplace. All right, so everybody's out there, Jeremy, all the economists and analysts trying to pick a bottom. And, every day you see the bottom fall out, and then you see a little revitalization. The next day we're in the green, and everybody says, well, this may be the bottom. And then the next person says, no, we still got more to go. That's why, was it Milton Friedman say, that's why economists have two hands, because you always have to say, well, on the other hand.
Yeah.
So you care to hazard a guess, in your professional opinion, where we are on that?
Well, from a stock market perspective, here's the interesting thing. If you look at midterm election years, you tend to rally through the midterm election and into the end of the year.
Okay.
Right. So if I was saying based on the seasonal trends and assuming that we get a divided government, and I think that's why this market's bouncing up and down right now. The market's kind of looking to see, are we going to get this divided government
and we're getting
that everyone's expecting?
Closer to that reality.
We're only a couple weeks away from the midterms, right? And so the market's just kind of seesawing here. I think if you get a divided government, you're going to see the market rally higher through the end of the year.
Huh. Okay. I know you've said that every time you come on. You've been very consistent, and I know you've done a lot of research on this, and you've reviewed historically
Yep.
how that's always worked out. And
Yep.
so you believe that history is instructive on this, and I hope you're right.
Yeah, and we've kind of become complacent. We know the Fed's aggressive and they're going, and that's priced in the market. It's not like it's a big secret anymore.
Yeah, they expect it now. Jeremy, appreciate you coming on. Always enjoy your insight. Thanks.
Appreciate y'all. Thank you.
Got it.
Bye.
We're coming right back on Middays. We're in the Element Wealth Studios. Stay